Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Alphabet Incorporated, ticker GOOG. It's been about a year since we last took a look at it. I think that there's a lot of good things for it. It's kind of undervalued compared to its peers, and I'm just very bullish on it in general. With 66 analyst ratings, 13 are a strong buy, 42 are a buy, and 11 are a hold. No one says underperform, no one says sell. I feel like its multiple has been compressed because of all of the AI hype, and people think that AI is going to replace search, but yet Gemini is constantly rated the top AI model. And honestly, it's the one that I use because it comes built into my phone. And soon enough, it sounds like it could be coming built into the iPhone as well, because Apple's giving up on their AI attempt and decided if you can't beat them, join them, and are looking to partner with Google to get Gemini on their phones. Because when it comes to the mobile phone world, in the past decade, it's been basically all Google for progress. Apple has fallen behind. They haven't been relevant for about a decade. And I swear everywhere I look, people have the Google Pixel now. It's by far the best phone on the market. And especially with the EU cracking down on the iPhone, making them switch to the Type-C cable, go to RCS, there's no differentiator there. It's going to be very easy to transfer to a different phone. And if you're going to go Android, you might as well go the owner of Android, Google. So I think in the mobile world, they're the biggest player at the moment. They don't have too much of the market, but just watch in the next few years, they will become a player. But they also own YouTube. I know that most of the content I consume is on YouTube. You're watching YouTube right now, and that brings in a lot of revenue for them. And then, of course, there's search. They're definitely less reliant on search now than they were previously. People use their name as a verb. I'm going to Google something. So it tells you the role that they play there too. They're a massive player in many different places, which makes me wonder, why the heck are they trading at a PE of 21.5? I mean, we'll get through this thesis, but I'm coming up with average annual growth of almost 15%. It's over 15 once you factor in the dividend, which puts the PE, a reasonable PE, well above 21. Look at some of the other FANG stocks, and they're in the 30s, maybe even the 40s. Google is trading at a deep discount if you think that the others are fairly valued. I'm coming up with a fair value of 210.5, let's say 211, and it's currently trading for 213.5. So it's right at the fair value, and I did buy some this last week. 52-week high is 215, and the 52-week low is 142. So it's not super volatile like we've seen some of the others as well. Seems to be a pretty consistent grower. Now, cash flows, it just doesn't seem like they're growing their cash flows too quick. I mean, you can look here, mid-low single digits, but they still have a super strong yield. And we'll get into fundamentally solid across the board. Earnings yield of 6.8%. So for what we're paying, this 213.5, we'd want at least $10.68 in earnings per share. And what we're getting is essentially that for this next year, according to analysts. Cash flows, 20, let's just round this up to 21. Super strong. It is down a bit from what we saw from them on average, 22.65. We can take a quick look at the chart and see they're just generally consistent within this range here. You're not seeing any massive spikes in growth, and that's probably why they're trading at a discounted PE to all of their peers. They still have an earnings growth rate of 7%, which does give them a PEG of 3. So, I mean, it is definitely a lot less growth than some of their dividend yield. I mean, they just started paying out a dividend in 2024, so they're growing it quick. Right now, you're getting less than 0.5%, but if they continue to grow it, they're currently trading they're currently paying out 21 cents a quarter. If they bump that up to somewhere in the realm of 26, you're looking at a 50% growth right there. Definitely reasonable. Payout ratio is super low. If they're getting to the point where they're not getting a whole lot of growth, they're just getting consistent small growth, less to invest in, you start doing buybacks and dividend payouts. Now, they're really good on buybacks. Share count, they're buying back around 2% a year of shares, which is great for investors. ROE is incredible, almost 31%, and debt to equity is not bad. They do not have a boatload of debt like a lot of companies that we look at. They are in a solid place with their balance sheet. ROI is really good too, 19.63, and ROA 22.22. So they're getting very solid returns for what they have. Gross margins 58.29 on average, 56.85 for a company like this. 60 is definitely reasonable. They're headed that way. Net margins 28.57 on average, 25.82. Again, for a company like this, 30 is completely reasonable, and they're headed that way. The thesis is actually very easy to come up with because they're very consistent. Analysts are expecting 12 to 12.5% over the next 2 years. 12% for our thesis. Share count, 1.5 to 2.5. 2 for the thesis. Cash flows, this one, I mean, it looks small historically, but if your revenue is growing at 12%, then your cash flow yield will be going down quite a bit if you're only bringing in 6%. If they can do 10, their cash flow yield is still going to drop below 20. I want it to hold above 20. So let's see what a 13 gets them. Well, so an 11 gets them just shy of 20. Let's see, 11.5 gets them just north of 20. So I'm more comfortable with that, and that helped them out even more. Asset growth, super consistent. Somewhere in the 7% range, 7 to 8. Liabilities, again, 4.5 to 5. So we'll go with 4.5 there. Dividend, like I said, they just need to grow it. A 5-cent per quarter raise is more than reasonable, and that's all that they need at the moment to do 50%. I mean, if they do 50%, it'd take them up to, in 5 years, a dividend of $6.83 per year, which would be a yield on cost if you buy at today's price of 3.2%, which is a solid yield. That's kind of what I target for my dividend stocks. And then margins, we see some small growth, have the gross climb up towards the 60% mark and the net climb up to the 30. All that together gets you annual growth of 15.2, factor in the dividend, 15.6. I have no doubt you're going to outperform the 8 to 10% that you typically see out of the S&P over the course of the next 3 to 5 years. And that's why if we see a dip, I'm going to buy even more. But for now, I'm just going to slowly dollar cost average it. So that's another one from the watch list that we're getting updated. I do want to take a look at Ulta after their recent earnings. Oracle, it's the one that we haven't looked at in the longest period of time. And then NVIDIA with their most recent earnings as well. See how all of those are doing. So those are the videos that should be coming out over the next few days and weeks. If I'm checking the numbers on a company on the watch list, I almost always put a video out. And that's all for this one. So I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.